Hello and welcome. Today we're working on a small fee or a small expense. We need to be worried about that. Beware of small expenses because it can make a big difference in a portfolio. Hey, if we haven't met, my name's Jeff from Finally Learn. I teach financial literacy. I have lots of videos explaining lots of issues in Excel or accounting or finance. So please join us. Please like and comment, subscribe. We'd love to have you. Benjamin Franklin had a famous quote, "Beware of little expenses. A small leak will sink a great ship." Well, it really is about a ship, right? If you have a small leak, if you got on a cruise ship, you're taking a cruise and they say, "Oh, we have a little leak." And you say, "Okay, that's really bad." And they say, No, it's not that big a deal. It's a big ship. It's just a small leak. No big deal." Well, I'd want a captain to be more concerned than saying, "Hey, it's no big deal." But a lot of times investors or people in their personal finances would say, "It's not that big a deal. It's just $20 a week." Well, $20 a week times 50 weeks, 52 weeks, is $1,000 a year. And they say, "Well, I wish I had $1,000. Well, there's a way to do that. Save $20 a week. There you have $1,000, right? So one thing I did was I looked at NerdWallet, and it says, how much does a financial advisor cost? And I kind of knew this, but I wanted to point you in the right direction. So a traditional in-person financial advisor is 1 to 2%. I think the majority is at 1% now. That's the kind of the median. Might be a little lower, and if you had a larger portfolio, then that works. Or they do a commission of like 3 to 6% of the investment transaction. So this is based on trades. Now, let's go back and look at an example. So let's say you have a friend. Hopefully it's not you, but you have a friend that says, "Hey, look how smart I am. I have found a checking account that has an interest rate of 3.5%. And you say, "Hey, that's fantastic." Now, let's assume that they have $40,000 in that checking account. And they're telling you like, "Oh, this is so good. I've switched," and they're just kind of bragging. They're so happy about it. They're telling you like, "Oh," and they're kind of implying, "Look how smart I am. I have 3.5% rate of return. I'm just making so much money." And you think, "Okay, great." It's 3.5% times whatever's in the checking account. If they have 40,000, then they're making 1,400. Let's say they have 60,000 in the checking account. Well, they're making 2,100. Fantastic. What if you asked them and got nosy? Now, typically we can't do this, but you said, "Well, how much is in your brokerage account and how much is the advisor fee?" Well, there's a lot of people, quite frankly, that don't know how much they're paying for their investment advisor. And a lot of people, they don't want to know. They kind of use the strategy of put the ostrich head in the sand. So they use the ostrich strategy. I'm going to put my head in the sand. I don't want to know. Don't tell me. I'm happy unless you tell me exactly what it is. Well, I'm going to tell you. The typical fee is maybe 1% of assets under management. If they have a portfolio of 500,000 times 0.01, it's costing them $5,000. Now remember, investing is not really a skill because the market provides the returns. It's not the person that has the best degrees or whatever, or they're the hardest working or the smartest. We all, the rain falls on us and the sun falls on us, and we all have investment returns from the market. The market provides the returns, not the individual investment advisor. So what I'm saying is, you get this return, but you're now paying $5,000 for your investment advisor. Well, let's do another example. What if they say, "Oh, it's 3 to 4 to 5 to 6% commission on trades"? Well, let's do some calculations. What if they make trades of half the portfolio. The portfolio turns over half of it during the year. Now think about this. If you get paid because you make trades, then you're going to have more trades, right? If you have an advisor, a broker, a money manager, and they get paid on a commission, then you're going to have more trades than if they don't have commissions. So let's say it's 250,000, so half, and then they're going to multiply it. Let's just say it's 5%, right in the middle somewhere. Then you're paying $12,500 for the privilege of investing your money with this broker, investment advisor, money manager, so on. Now, you can do this with index funds, and you don't have to go pay more to work with somebody. Now, they're going to take care of you. They're going to be able to answer your phone call. Say, hey, what's going on with the market? And they'll have an answer, right? You just call me, and I can tell you what's happening with the weather. Well, it's raining, it's sunny, it's getting cold, right? So if you call, they're going to answer. They're going to take you to lunch every quarter, and they'll say, hey, here's what the market's going to do. Here's what we're going to think about. But they just don't know, right? One of the things that happens is you're paying as if this is really skill. It's not. We all benefit from the market. The investment returns are luck. If it were skill, we would avoid, the years that were losses. So let's think about this in a different way. This is my quote. I just created it, and I thought it made sense. Paying a broker, investment advisor, money manager for better returns is like paying a weatherman, weather personality, meteorologist for better weather. Let's say we want better weather. Do we go and pay and find the best weather personality out there? Well, that's not going to affect the weather. Paying a broker, paying a money manager for better returns is not going to affect the total returns, but in fact, it will affect your return in a negative way. If you pay more, you're going to get less. Always, always true in every situation. Now, no one can predict the future. Investment returns are not based on skill, so it is random to us what the market's going to do tomorrow. What if I said, hey, the market's going to go up tomorrow? Well, I probably have about a 50% chance of being correct. But what matters is, well, how many days will it be up? How many days will it be down? What's the percent up? What's the percent down? No one knows this. One of the things we have done with computers is we plugged in all this information. We thought, hey, we could, figure out a way to predict the market. We just can't do that. People cannot predict the future. You cannot predict investment returns. You just don't know. Even professional investors do not beat the market, especially after you account for the fees. If you pay 1%, they've got to be better than that to even match the market. Remember, there's such a thing as the S&P 500. So the S&P 500 is the stock market of the largest 500 U.S. companies. And you can invest low-cost index funds that track the S&P 500. You can invest. You don't need a professional investor. The ordinary people can do just as well or even better than the professional people because we don't have all these extra fees and these extra costs. So investment fees reduce your return. If you pay 1% to a broker, then it reduces your fee by 1%. Yes, you may get 8% return, but you've got to pay 1%, you're only going to net out 7%. And unless you're very careful and really understand this, then you think, oh, well, my portfolio's up. Well, it could have been up 8%, it was only up 7%. Focus on the dollars and not the percentages. If you have a portfolio of $500,000, 1% is $5,000. Would you write a check to that broker and say, here, manage my money, here's $5,000? If you don't want to do that, then you shouldn't just say, yeah, that's fine, because it's 1%. Don't ignore small expenses, especially when it's as a percent. They want you to think about a percent. No big deal. It's just so small. It's like how casinos want you to focus not on the dollar amount, but let's red chips and blue chips and black chips. It's just chips. Don't worry about it. But it represents real dollars. You can do it yourself. You can do it yourself with a 3-fund portfolio. I have videos about the 3-fund portfolio. And within that, the investment expenses are about 1/10 of 1% or 0.1%, less than about 1/10 of 1 full percent. You can buy, there's many low-cost index funds that just track the market, like the S&P 500. You don't have to pay extra to be an investor. You can do it yourself, and you now have a $5,000 incentive each year to do that. You could pay yourself essentially $5,000 by avoiding the cost. So let's go back to what we were thinking about. Yes, I'm happy you got a 3.5% return on your checking account, but I'm more concerned that you're really wasting $5,000 or $12,500 or whatever that number is. You can just plug your number in the privacy of your own home. Just plug in what that number is times 1%. You're paying at least that for your investment management. So yes, having a little interest-bearing account at 3.5%, you're going to save a lot more money if you avoid the 1%. So this whole thing is titled, When 1% down here is larger than the 3.5%, focus on the dollars, not that small little 1% that you think doesn't matter. It really does matter. Save your money, low-cost index funds, and you could beat professional money managers. Hey, if this video is helpful for you, please like, please subscribe, please thumbs up. And if you have questions, put them in the comments below. I've got lots of information I can give you on this type of investment. You can do it yourself. It doesn't take any skill. It just takes a little knowledge.